Trent Bradshaw, Brandon Rogers, Bradshaw Financial Planning, and Mind Your Money. Thank you for joining us for this market update. Today is June 17th, 2022. We're coming to you shortly after the market close here. A couple things we're going to touch on today. Absolutely going to talk about inflation and what happened last Friday with the report. Obviously, the market had a tough week in response to that. A lot of fear rolling out there. Actually got a little bit worse over the last week. But then we're going to bring a small piece of optimism that I think you'll be glad to take a look at. It's a contrarian indicator, and we'll talk a little bit about that. All right, jump right in. First chart we're going to look at inflation numbers year over year in regards to consumer price index from April to April compared to May of 2021 to 2022. And primarily what you see here with the increased inflation, we've got them circled over on the right side of the chart. The inflation numbers were pretty much driven by food and energy. I mean, no surprise there.
It's the most volatile sector, so.
Yeah, absolutely. I mean, it was just some of the numbers just skyrocketed from month over month. And, one of the bright spots you'll see there circled in green is new vehicles and used cars and trucks. Some of the prices are starting to tilt on the downside, which is exactly what the Federal Reserve wants to see. But fact of it is, CPI came in at 8.6. Fed got aggressive on Wednesday this past week, increased interest rates by 75 basis points. Doesn't look like they're going to be I guess the term would be dovish when it comes to increasing interest rates going forward either, Brandon. So talk a little bit about this chart, this illustration of the CPI.
Yeah, so we look at this chart, it's actually going back to December 1981. And you're really just looking at the CPI, which is the inflation indicator. And you can see it's the highest levels really since then.
40 years, isn't it?
Yeah, it's a massive time frame. So again, this is, unprecedented time. Nobody's really, well, some people may have lived through it, but you haven't really experienced to this extent. So a lot of people are doing this for the first time. So you're feeling this, obviously, in the grocery store, at the gas pumps. The stock market, obviously is taking it, is on the chin as well because of all this. But again, we need to get that number under control to have some turnaround here in the market. Again, this affects everybody, right? Not everybody's invested in the market, but everybody, has a job. They have to eat. They have to go to and from work, or just get around. So it really is a massive impact on individuals.
Well, another thing is on the chart. I mean, you can see it. It's absolutely spiked to the stratosphere. I mean, we're back where we were in 1981 as far as the inflation. Fed's going to be aggressive trying to bring that back down. And if you look at the average of this chart, it's somewhere in the range of 2.5% to 3%. So that's where the Fed's trying to get the inflation numbers back to. And, hopefully they can do this through the interest rate increases that they're going to do. But, in addition to that, this month, Brandon, they started the quantitative tightening. So what the Fed is doing now is they're trying to pull $47.5 billion out of the balance sheet. Of course, it's sitting at about $8.9 trillion right now. They're trying to bring that balance sheet back into a normalized state. It's going to take years to get there if they're successful with it. But ultimately, they're going to increase that to $95 billion coming up per month starting in September. So their goal is to try to peel off about $1 trillion off that balance sheet each year. But in addition to that, increasing interest rates with that, it's almost like getting another quarter point increase for every $300 billion that they pull off. So the Fed's being ultra aggressive right now with the interest rate increases. The question is it a soft landing, or are we going to have a hard landing? Is that hard landing going to drive us into recession?
Yeah, and it's going to take a while too for this inflation to get under control. You saw earlier on that slide where from the early 80s, it took about potentially 2 to 3 years. So as long as we start seeing that trend going down the other way, that will definitely be a positive.
We'll touch on the probability for the July 27th meeting.
Yeah, so again, like we just had the last Fed meeting this past Wednesday, and they did increase it to 75 basis points. It was 50 was the thought process until the CPI number came out the Friday before, and then obviously they decided to change it to the 75 basis points. So this looks for the next Fed meeting. That's again going to be in July, towards the end of July. So you'll see here on this chart where the probability is of another 75 basis point increase. So again, the Fed needs to be careful. They need to do something to combat inflation. This is how they're doing it. but they can't do it too fast and too much, right? So it's a very tedious process. I wouldn't want their job by any means, but this is what they're trying to do to control it. But yeah, overwhelming consensus is that having another 75 basis point increase.
Yeah, and there's potential. We've talked about this before. After the July meeting, there's not another meeting until the September timeframe. Of course, they got Jackson Hole, Wyoming, where all of them get together and discuss the economy and so forth. But the September meeting's quite a gap between July and September. That's when you and I think that the Fed will back off, maybe take a breath and consider where things are at right now. Again, it's a balancing act between that soft landing, hard landing, and whether we go into recession or not. But, you know, right now, if you look at the overall breakdown, the potential is there because when you look at this next chart, we're talking about the rates and the spreads. If you look at the 2-year note all the way to the 30-year note on the left-hand side of the chart, what you've got here is pretty much a flat yield curve. Yeah. When we get a flat yield curve or when it inverts, that's a precursor to when we see a recession. So hopefully the Fed can fight through this and we avoid it. But you know, we'll see when we get the GDP numbers for the second quarter here.
Yeah. So what you're seeing again, that you see the 2-year, 5-year, 10-year, 30-year. There's really no difference. Like, why would somebody want to hold a 30-year note if the 2-year, you know, pays close to what it's paying? So that's what we mean when it's starting to flatten out. Normally, hey, if I'm gonna hold it something longer, I want to get paid more for it. So that's just kind of what we're seeing is that, as you mentioned, that yield curve flattening out.
Right. Last chart we got, this is the optimism we were talking about. It's really the University of Michigan Consumer Confidence chart. And what you can see on the far right-hand side of this chart, that number has cratered down to around 50. We're honestly sitting at roughly a 40-year low on consumer confidence, which is pretty amazing. I mean, that includes the shaded areas on this chart, which were the recessions, but it goes all the way back to the dot-com era. It goes back to
financial crisis.
The financial crisis in 8 and 9, and then here we are. But this contrarian indicator could also signal what?
It's kind of that rebound.
Yep.
You know, maybe we were at the bottom. Nobody knows where that's at. That's where everybody's feeling around and see, you know, where we're at on it. But it could be at the bottom, you know, based on this chart, because it is. It's pretty low. It's pretty low.
So obviously we wanted to bring you this market update. We didn't want to be all doom and gloom. That consumer confidence with the University of Michigan, and again, can be used as a contrarian indicator. So it's at rock bottom right now. So this may be getting close to where things settle out, but we'll keep an eye on it. We'll be back with updates. Make sure you join us on social media. Make sure if you got any questions, just to email or give us a ring. Be glad to answer those for you. Trent Bradshaw, Brandon Rogers, Bradshaw Financial Planning, and mind your money.